Hey everybody, Courtney Smith here. Let's rock and roll. Starting to see some disturbing things like, oh, wait a minute. This is the disclaimer. Sorry. Okay, let's take a look right here. We had a big down day on Friday. It started out on news of increased trade tensions. But the market, as you can see, started to rally and close pretty strong. I mean, it still closed down, but it did close strong. Purple Predictor remains very bullish, but it's a bit of a mixed bag. Still bullish, though. But as you'll see as we go through, some things are starting to deteriorate. Now, I wanted to focus on just the last couple of weeks. So we made a new all-time high on Wednesday and then closed on the low of the day. On Thursday, we were up slightly, but it was a very weak bullish day. Friday was the key day. We opened down, we dropped pretty sharply, and then we rallied to end up near the high of the day. So the close of the day was actually bullish, and it all occurred on very, very high volume. So this is kind of a moderately bullish situation for Monday and early next week. Now, but here's something that's disturbing. Here's the Dow, and in my little yellow box in the upper right-hand corner, the red line just went above the green line, which shows that there's now more selling pressure in the market than buying pressure. Now, remember, Friday was a bit of a weird day, so it's possible that by the end of Monday, this will have reversed and we'll see the green above the red, but right now, as we speak, after Friday's action, what we're seeing here is slightly more selling pressure than buying pressure. Just slightly, but still, nonetheless, we have to keep in mind. Another disturbing thing is here we see on Thursday, the Nasdaq makes new all-time highs, and then the purple predictor moves into bearish territory. So at the beginning of the week, it was above price action. At the end of the week, it was below price action. Once again, so far, none of these things are all a little disturbing, but they're certainly not calling for a bear market by any means, but maybe a slowing of the bull market. Seasonality remains wildly bullish. Notice the IWM had the same plunge-o-rama early in the day, but actually closed higher on the day and made a new all-time high close. It tells us that if we can pick our stocks right, we can be making money in this market, and fully paid up members, we're crushing it in the stocks that we own. So that that's a true statement. We just have to be able to pick those stocks right. Dow stocks? No. IWM stocks? Russell 2000 stocks? Yes. Seasonality should be dribbling lower, but it's starting to become a non-event until the fall, when we should start to see really bullish price action. The yield curve also really not important anymore. It's really going to tell us for the next year. It's not going to be a factor in the market at all. So we can pretty well ignore it now. Asset allocation, though, didn't make a new high here. You can see it's okay. It's okay. Not good, not bad. But the stock market risk indicators started to come down, and for fully paid up members, you'll see that the consumer staples, which are a safe haven type sector, they started to perk up. Utes didn't really start to perk up, utility stocks, but nonetheless, we did see the consumer staples, which is a place where people go as a safe haven when they think the market's going down. They did start to go up. So we're starting to see the market pull back from the risk that it wanted to take and want to be a little bit more conservative. Generally speaking, that's associated not necessarily with a bear market, but with a lack of a strong bull market. Global shares are weaker than U.S. shares by a long shot, as you can see here. The one that was most interesting to me is emerging markets, and I really want to get short these things. So for our fully paid up members, I don't have a trade here yet for you, but I'm looking at it very closely. Bonds, chop, chop, chop. Notice we're at the same price we were in February. So basically, we're just, very, very volatile, and yet ending up going nowhere. Let's take a look at our key factors. The green line is the 10-year treasuries, but notice all the other factors are saying we should have lower interest rates, every single one of them. The gold line, that's gold. The blue line, that's 10-year German treasuries. And the chart itself, that's the CRB. All of them saying we should see lower interest rates. So let's go back over here. That means that we should see a rally here. Now, the last time we had a rally was a few weeks ago. We got up to just over 122, which was slightly higher than the late March high, which was around 122. We need to break above that before I can really get excited. But now we see those critical factors are starting to turn bullish for the bond market. Remember, higher bond prices means lower interest rates. The dollar, whoa, look what happened on Thursday. Huge price action. Obviously that's what's called a key reversal. When you have a day that's that mammoth, it's considered to be the strongest of all daily bar chart patterns. And look at what it did. It did something incredible there. So what we're seeing is that, but then on Friday, that's not that great of a day. It closed in the lower half of the range, suggesting that it closed on a weak price action. Nonetheless, that huge outside day has to be looked at very, very closely. But the problem was there was no follow-through. This is what I was saying about Friday. No follow-through on Friday means that we have to now second guess the power of that move. So I just don't want to do anything. However, last week I said I thought we would resume the bull market. Now, this is the one I've been talking about. I didn't put a trade on, so my opinion is worth only so much. My trades are worth a lot. But I talked about why isn't gold stronger? And here we see we've broken down to new lows, new 2018 lows. These are the lowest prices in 2018. Look at that. So this is really showing incredible weakness. We really should be thinking of getting short gold. We opened on the high of the day, closed on the low. This is a piece of garbage, as they say in Ireland. Our gold indicators are now all bearish. All of them are pointing down. Crude light. Let's take a look right here. Big down day as well. As you can imagine, I just feel as though this is a piece of garbage as well, and we should be seeing this move much lower. We should get back into the 50s without a problem. Increasing supply. I do think global economy is going to actually, the growth will moderate, so the demand will not be as strong as anticipated, and we're going to see sharply higher supply. So I don't know if we'll get into the 40s, but we're definitely going to get into the 50s. Bitcoin really doing pretty much what we said it would do. We got the drop down on news of another exchange being hacked. This is like old news. I mean, like trading Bitcoin, very, very dangerous thing to do. I do not highly recommend it at all. And certainly the big monster bull market from last year is over. And in fact, I've even said we're going to go back down to below $5,000 for sure on this stuff. Right now, I think, though, that this breakdown is a fake breakout. I do think we're going to get to 4,000 eventually, but right now, look at the purple predictor. The purple predictor shows that some smart money is buying every time we have a dip. So I can't get really excited about the short side here. I'd rather wait for the dip to 4,000, be very, very patient, and then look for the big bull market to reassert itself. All right, these are pretty much, those are all gone, except for the one in Dubai where we will be having a Futures and Forex Masterclass. All right, freebies, we will see you later. Thanks very much for checking in, and we'll talk to you next week. Fully paid up members, hang in there for just a segundo.